Okay, so welcome back for the third lecture of this course, European Integration. Today the topic is going to switch to the mobility of capital. Big topic, and I just looked up some numbers today. These numbers are massive. You will not encounter many numbers that big unless you do physics and look at the number of atoms in the universe or something to that of that nature. We're going to talk about mobility of different forms of capital. We're going to talk about the capital market and ways of mitigating or the needs, unfulfilled needs of capital across the world, and the work that still has to be done. So there's a lot of unfinished business, even within Europe. And of course, this is about European integration. I'm going to focus mostly on Europe. But remember, the whole world is trying to develop, and we've got this problem of global warming. So use of capital usually involves energy, and generating energy usually involves putting CO2 into the environment. So these are all things you have to worry about. I'll talk about that briefly later on in the course, but today we'll play the game as if, we just want to understand capital first, and we understand all the problems with it, and then the use of capital involves energy, but I'm fairly optimistic that as Germany moves forward as a beacon to the rest of Europe, maybe even the other way around, we might learn something about using renewable resources from others. This involves capital too. So learning what you do today about capital mobility will also be applicable to how do we get solar collectors produced in Europe and sent to places where there's lots of sunshine, right? And how do we build hydrogen extraction facilities using Spanish or Greek or Italian sunshine? These are really interesting questions. Unfortunately, the level of abstraction here can't address it directly, but it'd be a great topic maybe for a thesis or for some future seminar. Okay, today we're going to review last time as usual. I'm going to talk very briefly about total factor productivity to remind you that this is not about countries that are different fundamentally. We're talking about integration within Europe. The hope is that Germany and Poland have roughly the access to the same technology, the same rule of law. Finland and Poland, as we've talked about in our little example, or even a new accession country like Croatia. The idea that they also have access to German technology, to French technology, and they can implement it in a way that puts them on the isoquant of output for the European Union. That may not be true between Italy and Algeria, or Italy and China, right? So there are fundamental differences in the production function that may be changing over time. I just want to make you aware of that. So I'll talk about TFP briefly. But after today, we will always assume that countries have the same production function, that the regions that are integrating have the same access to the same production function, and therefore don't get confused. It's easy to get confused, okay? And again, there's this development project in the world which is super serious, super big, and also super burdensome for the environment, for global warming. All these things have to do that as well. But think about first the small picture. Get that in your heads and think about the abstraction. What is the capital stock given the production function? Again, we're talking about mobility as opposed to accumulation. Last week we talked about the Solow model, which says we do it by ourselves. We have to save and save and save. It takes a long time. Now we're going to say, hey, can you send some of that stuff over here? Maybe not for free. Maybe the person doesn't want to give up ownership and wants to continue to get income from that capital ownership. But what if we in Germany can work with more capital? What if Poland can get more capital from outside, from Finland, for example? The Finns will still get some capital income, some profit in the normal sense, normal economic profit from that. But how much of that can actually happen? It turns out there's a lot of capital mobility, and this reminded me of something someone told me a long time ago. If you drive a truck from this region to another region and you put it to work in that other region, that's capital mobility. If you take a crane and move it across the national boundary, that's capital mobility. If I sell a bunch of computers to someone in Albania and they put them to good use, that's capital mobility in our sense. A lot of people use capital in the broader sense of ownership of the means of production. That's okay, but in this course we're talking about putting it in the production function to create a flow of output during the period. That's really what capital is for us. Huge topic and a lot to talk about. And of course, how does Europe deal with this? Well, Europe has lots of banks. Europe also has a capital market like the American stock market, but it's not quite as developed. Those are both vehicles for moving ownership of capital, of means of production across boundaries. And if Europe wants to move capital, it's going to have to secure the ownership rights so people will do it. That's kind of common sense. So that's why joining the European Union meant adopting the chapters on capital regulation, capital law, which means that if a Polish investor buys a bunch of gas stations in Germany, then that investor can count on being protected as an owner and being able to take some income back to Poland. And of course, I say that because that actually happened after the wall came down. So the Star gas stations you're probably familiar with was once owned by a very wealthy Polish investor. Of course, he's gotten rid of it now. In the meantime, this is what capital mobility is also about. Okay? But for us, it means moving the K, not just owning the K. So if I just buy a piece of K here in Germany and I'm living in France, that's just a swap of ownership. What matters is whether some K actually appears in Germany that wasn't there before. So it's a real subtle point, but it's incredibly important for us to understand how Poland can move from 2000 to 2023 at such rapid speed. Okay, it's about moving the K. It's really moving the K. Some German factories were actually taken apart and moved to Poland. That was a kind of an amazing thought. Just like some factories in Bavaria were moved to East Germany in 2000, even before, to take advantage of the different labor costs in the two regions. Okay? Now, this has risks, and I'll talk about those briefly at the end, because there's different types of capital mobility, and there's different levels and degrees of capital mobility. Sometimes you can just pull the plug like this, okay, if it involves financial assets, and that can lead to real consequences. Okay, we'll talk about that briefly at the end. We know what I'm going to be talking about. I'm talking about the debt crisis in Southern Europe in 2009 to 2014. Okay, so last time we talked quickly about how do the countries do it, how do the regions do it on their own. If you cut them off from any sort of capital flows, any sort of labor mobility, it's a slow process. It's painful, but it works. We've seen it work. We don't know if it's always to the common production function. Some countries have managed to attain the frontier, like Korea. South Korea has attained the frontier. China is very close. It's a big country, but many regions of China look like the wealthiest regions of the rest of the world. So this is kind of an interesting benchmark, as we've always pointed it out. And we've pointed out that you should have learned in Macro 1 how to deal with comparative statics, how to shift things around. This is certainly a valid exam question. You know, what would happen if the European integration project was accompanied by an increase in delta, for example? What would that mean for per capita GDP across the union? Okay, I suppose it was just a subset of the union, et cetera. Slow process, and I gave you lots of examples. Okay, so one minor detail that I didn't really go into detail on, I had time, I just didn't do it, was what happens if the production functions are just different? We're going to assume this is not the case, but we might have it. I mean, it might be the case that Albania really wants to join the EU, but they just have a different production function, and it can't be changed. It's just, maybe it's due to things that we don't want to necessarily go into detail, but if they're not the same, this means that we have this issue that marginal product of both factors will be permanently higher in the better off region, and the poor region will lose not only capital, but not only people, but also capital. It will be sort of the drainage that you would observe if Brandenburg lost all its people and capital to Berlin. Okay, a lot of people were worried about that. It's not the case anymore because something happened. Something offset that, probably some congestion issues, maybe the cost of real estate. But in any case, if we have that, we can only talk about conditional convergence. Therefore, the really poor regions of this world will always be losing people and possibly also losing capital. You know, it depends on the details that you'd learn in a more advanced course. So conditional convergence is the answer to that, and there's a lot of evidence. So if you control for things like education, infrastructure, stability, rule of law, lack of ethnic strife, those things can explain a lot of the difference in the level of the production function. So once you've accounted for that using regression analysis, you can actually still get a number like 2 to 3%. Okay, again, a pessimistic number, but still a benchmark that we can think about. I think it's interesting to talk about TFP within the European context. And the most interesting contexts for me are ones that involve Germany, because East and West Germany have no reason to have fundamental differences in TFP after the unification process is over, right? There shouldn't be, because they have the same laws, the same level of corruption, same level of confidence in government and rule of law, and the same levels of capital mobility. Okay, and the technology should be the same. So if we can't get convergence there, maybe we need to go back to the blackboard and write down a new theory. Okay, so how does it look? Not so great. I mean, there's a fundamental gap between East and West Germany. It's still there after 30 years, 30 plus years. And it's about 10, 15%. And it's just dogged. It won't go away, regardless of how you cut it. This is the productivity measures, productivity per hour. Robert Barrow actually predicted this would take a long time. But the first years, there was a lot of fast convergence. So we had this feeling that maybe this import of technology, this import of rule of law sort of got people on the same track, and it was just a matter of moving the capital quickly. And I think I told you this last time, since around 2000, Barrow has been on target. So TFP convergence has not been super great since 2000. So what is that? That's for economists, again, we've got a bunch of tools in our head to explain this. We have level of abstraction. Kind of makes us nervous because it turns out that the capital intensity levels in East Germany are as high or even higher than in the West. Okay, so this is again, another challenge for my Edgeworth box, because actually we should observe a monotonic convergence. Well, it turns out that if you look at the government sector, if you look at the agricultural sector, the K over L has converged quite rapidly. And in some industries, okay, but in others, in services, not so much. So that's one way of explaining it. Differential sectors, differential types of GDP. Let me just remind you how we measure this, because you can measure it. Look, we know what TFP is. It's effectively the level of the production function. Okay? High TFP, low TFP. A country that can use the same labor and capital in a more effective way, or it grows its capital and labor, it leads to more output growth, has more TFP. All right, so there are ways to do this. You can use the Solow decomposition that you learned about in Macro 1. It's something you can do in your bachelor thesis, by the way. Some of my bachelor students have done that. You can do it for one country. You can do it for many countries. You can take averages. How do you do that? Well, we'll talk about it in a second. But there's another one you haven't learned about, which is called the Hall-Jones, if you like, lateral comparison across countries. So how well does Germany look relative to the United States? Suppose the United States is the highest, it's up to question right now, but GDP per capita manufacturing is very high. Per capita of work put in per hour is the highest in the United States. For many reasons. The U.S. can get rid of its workers quickly. It's more productive in other ways. But in any case, this is kind of like a frontier. And you can think of how quickly or how much has Germany converged to that, or how much has France converged to that, or how much has China converged to that. So that's called the Hall-Jones decomposition. So I'll show you how to do both in the next slide. But remember, you need some data to do this. You need GDP data. You need data on the factor inputs. So I'm assuming that countries can get their act together and measure GDP, which is not a given. GDP in the Sudan is not very easily measured right now. And I'm not trying to be funny. It's a serious problem. Some countries can't afford to measure GDP more than once a year, right? And Germany has the luxury of doing it every quarter. A lot of researchers complain, why don't you have monthly GDP? Why don't you have daily GDP? It costs money. You have to actually survey lots of companies. It's very expensive, especially nowadays. Labor is expensive. Okay, so you need things like delta Y over Y. That's the growth rate of GDP measured in constant euros or dollars. You need a measure of the capital stock, and we've seen last week measuring the capital stock ain't easy. It's an aggregate of lots of different investment flows with depreciation rates. Statisticians spend lots of time computing that. But we can get that from the internet. L, how many man or person, woman hours have gone into production? Right? So those are the things we absolutely need. And we need another thing called SK, which is like the share of capital in GDP. And 1 minus SK would be the share of non-capital or labor in GDP. Once you get that, you can compute TFP as simply the difference between the observed GDP growth and a weighted average of the growth of the factors. Now, if you can understand that, write it down. You'll get a great job with McKinsey because they need people who understand that, right? And you can do that for a firm. You don't have to do it for a country. You can do it for a region. You just need the data. It's basically the unexplained growth in output that cannot be attributed to the inputs, right? So that's it. Wow, eureka. I can apply this to a lot of things. If I'm running a little company, I can actually apply it, okay? You can extend this because we have people that doesn't necessarily equal workers or person hours. You need to know how much of the people we have in a country or a region are actually working. Because if they're not all working, then you can't say N equals L. Okay, so you need some sort of utilization mechanism, so we can do the same decomposition for capita, but then it's not the same thing, right? Because the change in labor may not be equal to the change in people. Because some people may retire early or they may retire late. Maybe that changes. Maybe just using people more intensely by extending the retirement age can increase GDP per capita. Okay, and the best example of that is France. You've heard that there's big unrest in France because of the retirement age. And France has the luxury of having a retirement age of 62, which they want to raise to 64. And as you know, in Germany, it's already 67, we're on our way there, basically. Okay, so what is the difference? Well, France doesn't utilize its population, ceteris paribus, the same way that Germany does, or the UK, or Sweden, or the United States. That means that French GDP will always be a bit lower per capita because not all the capita are working, right? Think about it. So even if Germany and France have the same unemployment rate, you're going to have different output per capita. Maybe the French are happier. Maybe we need to think about happiness. Maybe the French are happier, but my goodness, they're really destroying a lot of stuff. I don't know how happy they are right now. Maybe they're unhappy because they're changing the rules. Maybe they're thinking maybe someone in the future will increase taxes on the rich people to pay the people in retirement. Okay, these are things you'll learn about if you take a master's degree in economics, overlapping generations, because the young people ultimately pay for the older people in most pension systems. Anyway, I'm talking about the production function. So what could make a difference between French change of GDP per capita and the German change? It could just be that Germans utilize their labor more effectively. And we saw that after the Hartz reforms, many more people got into work, and that grew GDP, even though the German population didn't change much. Okay? So keep that in mind. That's a really important point. That's an adjustment. Now, what I wanted to allude to is there's another way of doing this, which is called the Hall-Jones decomposition, which means, okay, I'm going to take a benchmark country. I'm not going to look at time, change over time. I'm going to look at a single point in time and look at how far GDP per capita Germany is from the United States, or how far Niger is from the United States. Okay, and how much of that can be explained by the difference in output per hour or per capita. So I do this in Germany just to make things really clear. I'm going to do this letting Baden-Württemberg, you know, where Boris Palmer's from, you know, as the most productive, which it is, the most productive part of Germany per hour compared with the rest of the Bundesländer in Germany. So you've got Berlin, you've got Brandenburg, Saxony, you've got you know, North Rhine-Westphalia, and Bremen, all these other crazy places, Hamburg, and you can benchmark them with respect to Baden-Württemberg. Okay? So the Hall-Jones guy is simply saying how much of output per hour can we explain as a distance to the border, the frontier, which is Baden-Württemberg, and how much can we explain with the different capital intensity which is operative in Baden-Württemberg. Baden-Württemberg is a very capital-intensive place. In Ländle, there are lots of factories. Okay, so that makes a difference if you're comparing Ländle with Schleswig-Holstein, right? So it's a decomposition. That second term in the first line is a residual to be explained, so I can rewrite it, and the last line is simply a definition of this technological gap. Okay, so we can use that to figure out how far the new German states are from Baden-Württemberg. Okay, that would be TFP. So how quickly are these guys catching up? Well, the answer is it's been very, very slow going. Okay, we're still talking about a difference here, 2015, of about 35%. The last time I calculated, we were talking about 20%, so there has been some convergence, but there's a big, big difference. And it hasn't changed much in a time when things were getting better in Eastern Germany. Okay, so there's a little bit of reason to be a little bit cautious. When you do this comparison, and you'll see from the picture that we've kind of reached a plateau. And I'm still very optimistic that especially in the last few years where Germany has had a big energy shock, a lot of the southern German states are going to lose some competitiveness because they don't want to have the Windräder, they don't want to have the wind generation in their backyard. They don't want to have the electricity transmission facilities to get the energy from the north. The north is going to have a wind situation. So the value of having a lot of renewable resources in the north means that maybe the TFP level difference we see between Baden-Württemberg and the rest of East Germany will disappear over time. Okay, so enough of that. Is there any questions about that? Any remarks, or I just want to stimulate you a little bit. Economics is like an open book. You never close it. Keep turning the pages. You keep asking yourself new questions. Can we accommodate this? And eventually, some of these theories are not very useful for explaining things, and they get abandoned. And I can give you lots of examples of that. But this is, the Solow decomposition has been used time and again to explain welfare differences. So you had a question?
Yeah, yes. How's the labor...
Capital labor ratio?
No, I'm so sorry.
Employment ratio?
How's the education of the both East and West differ?
Right, great question. Okay, so the first thing people thought of when they tried to explain this difference was maybe the East Germans just had a lousy education. But if you look at the data, especially occupational training was more intense in the East. Okay, so you might say, well, maybe they had a lousy education. Quality is not equal to quality. That doesn't work, because the East Germans who migrated to the West had the same wages, same productivity, up to some maybe 5% margin. Sometimes they were. So clearly, there's something about the environment of working in the East versus the West, be it capital intensity, equipment, quality of technology, maybe mistrust. So one of the things I've been thinking about is that maybe mistrust is part of this story. It's hard to have a capitalist environment when you were living in a world 30 years ago where the Staatssicherheit was everywhere, and you didn't know who to trust. Because in business, sometimes you have to shake hands and trust on that basis. You have to keep secrets. Right? So who's keeping secrets? So this is just a theory, and there's a lot of evidence that verbal evidence that supports it. I can't prove it, but there are a lot of economic papers out there that do support this idea. Okay? Anything else? Okay, so let me switch gears. We talk about capital mobility. So now we're going to say same production function. Okay? With one picture, I'll qualify that, but even if you didn't have different production functions, you can still move capital sometimes and make a profit. So this is what drives a lot of investment, FDI. Okay, underdeveloped regions in Georgia, for example. Okay, Georgia. I'm not talking about the state in the United States. I'm talking about the country. It's a troublesome region. A lot of smart people, well educated. They've had a history. Some great people came from Georgia. It's a great tourist location. Actually a great investment opportunity. So if things were stable like they were before 2008, it would have been kind of a great place for an investor to go and put some money down, and they could make some money. It would be a welfare increasing move for the entire world because it would increase the marginal product of labor, it would increase the income to the investor. So for this to happen, either you do it yourself, the Georgians have to do it itself, or the Poles have to do it themselves, but it's better, quicker, more efficient if we can mobilize some foreign capital. And I'm talking about accumulated savings. I'm talking about what we, in the textbook we talk about foreign direct investments. That's a confusing term sometimes. First off, it's physical capital. I already said that, not financial. So otherwise, it's just a swap of assets. You got to be able to produce with this stuff. You can't produce with bank accounts. You can produce with a machine that you bought with the bank account or the loan. And again, foreign ownership is always an issue. So the Georgians, who allowed FDI before 2008, had to deal with the fact that some foreigner, could also be a Georgian living in Germany, owned that machine and was getting some income from it. So the Georgian GDP would be higher than GNI because some of the gross national income would have gone to foreigners, right? That's the difference between the two. So just to remind you, capital, we defined it last week, sum of undepreciated investment. Different types of capital have different forms of mobility. Okay, so in the abstraction, everything is equally mobile, but in fact, buildings cannot be moved. All you can do is depreciate them, use the funds that you've saved or as maybe on the basis of taxation, and then eventually move those funds abroad and make the acquisition of a new building or build a new building, which is what's important, right? So you're going to have low capital mobility in the short run, but some machines can be moved, some buildings can be moved, some structures can be moved, they're built to be moved, okay? And prefab buildings are a great example of that. And then you've got really the bulk of what I'm talking about is productive equipment, computers, machines, they can be moved. Okay, you can put a machine on a railroad car and push it somewhere and then actually put it back to use. And again, we've got financial capital, which may confuse some of you. You can't produce with financial capital, but you can swap ownership with it. So if you borrow some money from France and use that money to buy a French machine and put it in your backyard, that's kind of FDI. The French bank has the potential of taking it away from you. You owe it to them. They finance the machine, but the machine is in Germany and helps Germans produce. Okay, that's the idea. Now, how big is this? First, I have to ask you, since most of you are German, what is a trillion? In German, it's eine Billion, okay? Now, this is a hard question, but if you don't get this on the exam, it's going to be like a bonus question for you, okay? I'll give it to you. You have to tell me what a billion is in German, or eine Trillion. No, a trillion in English, eine Billion, okay? How many zeros? Dynamite, okay? 12, easy number to remember. It's like the rule of 70, 12. So it's 10 to the 12th power. It's a big number. What's the GDP of Germany? Who knows? You should know, you're economists. Look it up. What's the GDP of the United States? Yeah, it's more than that now. 20 plus trillion US dollars. I'll let you look up Germany on your own, okay? These are mega numbers. Now, if you divide it by population, it gets a little bit smaller. And you see GDP per capita, capital stock per capita. Here, this is outward measured stocks. Okay, so this is the accumulated foreign ownership of capital within a country. 38 trillion. Okay, that's a lot, because I bet you don't know what the world GDP is. So I worked on this today. The last measurement, 2000, 85 trillion. So 38% in measured in terms of GDP equivalent, 38 divided by 85 is the share of capital that's owned by somebody else. Of course, it always depends on how you define the country, et cetera. It's a pretty big number. So there's a lot of capital at risk because if you're in the country, it's different than you're outside the country. How does this relate to GDP? Okay, well, the world capital stock is about 120 trillion. Okay, so you do the division, it's pretty significant for the world. Now, in Europe, it's much higher. You can see that from the second line. Okay, so Europeans hold a lot of assets, productive assets, that are actually situated in other parts of the European Union, also outside the world. So we need to understand that. It's an important force. It's going to be a very important force between Finland and Poland, or between Germany and Poland, and it's nice to have a healthy attitude towards it. All right, let me just throw this at you. A big issue in Poland right now is the ownership of the media. What does that mean? Who owns the printing presses, but more importantly, who owns the rights to publish certain newspapers, magazines, etc. Now, it turns out that a lot of the ownership of the Polish media is actually in Germany. So you can see already this could be a political issue, right? Think about it. And a lot of politicians grab that as a great excuse to bash on Germany. Okay, but it's that way everywhere. It's that way in the United States. It's that way in England, Australia. I won't mention any other names, but it's clear, right? So capital mobility is an investment decision that is connected with a little bit of risk, because if you go to the wrong place at the wrong time, you may lose everything. And we're talking about a stock. So if you have your entire life savings in a business you've built up in Moldavia, things can happen. Of course, they can happen here, but you're not there, so it's a bit tricky to manage. We're going to reduce this to a comparison of after-tax rates of return. So taxation is also an issue. I'm just going to black it out right now. We're going to talk about return after taxes and subsidies. So think of the United States. Subsidizing green investment is kind of like changing the rate of return, but hold that constant. Ceteris paribus. Everything else held constant. I told you political stability matters. If a guy comes and asks you for a handout, that's also going to reduce your rate of return. So all these things matter, but we're going to just put it to rest right now. We're just going to look at the Edgeworth box. We're going to look at the comparison of those angles, and you learned last week and the week before that the rate of return is implicitly determined by the capital labor ratio. If you have a high capital labor ratio, you have productive labor, not so productive capital. It's not that you have too much capital, you just have a lot of it relative to those guys next door. So it's always this comparison. And you're an investor, you're thinking, well, should I move or not? Well, think of an internationally required rate of return as a benchmark. And again, I'm going to put the wall up between Finland and Poland and the rest of the world. So we're just going to look at those two interacting with each other. But it's always going to be a comparison of the marginal product of capital with some alternative opportunity cost of capital, which is the capital market gives me R star. This is basic stuff, but you probably saw it once and you haven't seen it again. Now you can see it again and think about it, because economics requires practice. It's like playing the guitar, you got to practice. If you stop practicing, if you don't use it, you lose it. Okay. So again, we're talking about this production function, common production function. What's the marginal product of capital? It's going to depend on capital intensity, since we learned that in our class. GDP per capita is a function of capital per capita only if we have a common production function. Okay? And again, this little intensive form production function has a positive first derivative. So if I give Germany more capital, they're going to get richer per capita or per worker, but it's going to be at a decreasing rate. So the second derivative of f, little f, is negative. And that's the saving grace of neoclassical economics. Okay? Otherwise, we'd be in trouble, right? So if you have increasing returns of scale, it's kind of everything goes out the window. Think about that. So basically, it's a comparison. And the high capital intensity country will tend to repel capital, and the low capital intensity region or country will tend to attract it. So in my Finland-Poland metaphor, it should be pretty easy to see. But it's a closed system, at this point. I've closed off the rest. So it's a zero-sum game. When Finland sends Nokia's machines to Poland, Finland has less capital for its workers. So some workers may lose their jobs, or they're going to have to accept lower wages in the long run as a result. So not surprisingly, a lot of people were grumbling about Nokia losing a factory to Transylvania. They lost some production facilities to Romania. Okay, kind of aggravating. Good for Nokia, good for the owners of Nokia, not so great for the workers in Nokia in Finland. Great for the workers in Romania. Right? So you have to think about that in terms of this little equality of the derivative, the absolute derivative. So if you're a big country, little dk is going to be a lot bigger than the dk star for the receiver country. We're comparing countries of roughly similar size. Over time, the marginal product of Finland will fall, and the marginal product of capital in Poland the marginal product in Poland will fall, and the marginal product of capital in Finland will eventually rise, and then eventually this will be equated. This is like seeing a convergence to the diagonal. And you can just see this by looking at the math, okay? So, if you like math, you can do this formally, and I think you might see this in the section briefly. If you just differentiate R, which is assumed to be the marginal product of capital in the region, okay, then it's just basically going to be the second derivative of the production function, so it's going to be negative. That's the first proof. And the second would be the converse or the obverse of that, namely the attracting country will, by virtue of attracting capital, will increase. The attracting country will have a loss of the marginal product of capital, and it will decline, and the Finnish situation will rise. Okay, so again, diagrammatically, look at those two angles, how they change. I've drawn this somewhat carefully. There's the first period. We're not quite there yet. Okay, you can see that the angle for Poland in the upper right part of the box rises, and Finland falls. Okay, and remember, Finland, in an open economy, Finland could also access the world to get some more investment if Finland had been at the right place at the right time at the beginning of this process. Okay, and you could also say, well, maybe Finland was exactly at the point where the marginal product of labor and capital, or capital was equal to the rate of return on capital, so Poland would have to import capital from the rest of the world. That's also a possible alternative. That would look like this. Okay, so Poland could import capital from a third country, but we've shut that down for the purposes of the example. Okay, and that would keep going until, indeed, if Finland were at the right place at the right time from the beginning, then basically Poland would look like Finland after this process is completed. And the box modified thusly is very, very high. And why is it so high? Because Poland has a larger population in the diagram, right, than Finland does. Although in the general analysis, we like to keep them roughly equal. Okay, so it's easy to see how this works. Now, again, a lot of people are not completely convinced. So and this is useful for you, to look at the isoquants. This is another way of understanding what's happening. So if Poland and Finland ultimately have the same capital stock per unit of labor, they're going to share the same point on the unit isoquant. If that's an isoquant that produces exactly 1 unit of GDP in either region, then they're choosing the same point. But they're starting at different places. Okay? So first, the slope of that isoquant is the marginal rate of substitution, keeping output constant. How much capital do I have to get to if I want to reduce labor by 1 unit and keep output constant? Or put differently, if I wanted to increase the input of labor from that point, how much capital could I dump and just put that labor to work? Keeping output constant. And I've normalized it at 1 unit. It could be 1 billion euros of GDP, whatever you want, but keeping that constant, how am I moving? So the outset, the beginning, has to have been different capital-labor ratios. We learned that from the Edgeworth box. So Finland was like this, and Poland is like this. And basically, the process is how do we move to the same point? So you can see, and if you remember, the ratio of the marginal products is the marginal rate of substitution. Right? So the first derivative of output with respect to labor divided by the first derivative of output with respect to capital is the marginal rate of substitution. Okay, and those things are moving as we increase capital labor in Poland and reduce it in Finland. Okay, so ultimately we converge to that point. So when you go home tonight, remind yourself of that. The slope of the isoquant is the marginal rate of substitution, and that's nothing but the ratio of two marginal products. Sometimes my micro colleagues don't teach you that. It's good to look at it, okay? Because if you remember in your head, well, the wage is kind of moving with the marginal product of labor, and the rate of return is the marginal product of capital, then you can see that that means we're moving along a factor price frontier at the same time. Okay, if I want to make 1 unit of output, I can pay a lot of return to labor, but I'm not going to use much labor. I'm going to have a very high rate of return on capital because I'm going to kind of have an incentive to do that. So it makes sense at this point in the course to talk about this as well. I just want to mention this, get this out here, because we're going to talk about it when we talk about trade. The ISO cost curve, which you probably didn't learn in micro, is another way of looking at this. Okay, so I asked the question, and this is used in trade theory a lot. If I want to produce a unit of goods at some price, that's a certain amount of value that I get if I go to the world market and sell it, how do I allocate that efficiently between capital and labor? So now suddenly we have a price. We have two prices, price of capital, price of labor. Price of capital services, I'm talking about buying the machine, I'm talking about renting it for a period, and how much do I need this labor? I don't own the worker, I can rent the worker, get the worker's services for a period, okay? So the same constant returns to scale production function gives us an answer to that question. It's the efficient maximal payment of wage and return to capital that is possible if I'm asked to produce 1 unit of the good efficiently. Why efficiently? If I didn't produce it efficiently, I would be throwing resources away and couldn't be paying the maximal wage given the rate of return on capital, the maximum return on capital given the wage. This is called the unit ISO cost curve. It is the dual of the isoquant. Isoquant, iso cost. The iso cost curve assumes a market. There's a market for labor and a market for capital. The isoquant is a technological assumption. Okay, I see I've already lost one of my best students now. What am I going to do? He's coming back. All right. It gets boring a little bit, but you have to understand, you don't have to be, you could be a Marxist and believe in isoquants. Karl Marx unfortunately didn't. Okay, he thought the isoquants were like this. Okay, but actually they have some curvature. You can still kind of be a Marxist type and still follow that stuff. But a market, when you have a market, a decentralized market, you're going to have labor getting wage, capital getting R. Right? So suddenly it becomes, we have a market. But the isoquant is a technological assumption about the way we produce goods and services. Now we're going to move just briefly to the market. This is a reminder what you should have learned in micro, and you will see it later. But it's a way of understanding why wages converge in Finland to the Polish level. Maybe fast, maybe rapidly, maybe less. Or put it differently, Polish wages will rise to the Finnish level. And if no capital is forthcoming, it's all got to come between Poland and Finland, and you can see what that means. Okay, so this is the formal mathematical definition of an ISO cost curve. So it's just asking, what is the minimal cost of producing 1 unit of output if I have to pay the rate of return R, and I have to pay the wage W? Okay, so why am I doing that? Because it turns out that the cool duality of this thing is that the slope of this ISO cost curve is the capital labor ratio. So it is why it's called duality theory. The slope of this guy is K divided by L. The slope of that guy in a market is the wage divided by the rate of return on capital. or the ratio of the marginal products. So this is like Eureka. Wow, that's cool. That only works with constant returns to scale. Okay? But it's kind of a magic that keeps economists fascinated with thinking about this, because it helps us disentangle some of the effects of capital mobility. Partially, we know that if capital moves from Finland to Poland, the Poles have more capital to work with. They may also get higher wages. The workers will get higher wages, and the profit rate will go up. How much of that is due to actually just moving along this isoquant, and how much is it due to maybe technological progress that I talked about already? Okay, so if you look in the textbook, there's a great sub-chapter on this. Okay, because the gains from integration are, in our little Edgeworth box, are solely only due to capital. But in fact, some of that capital may be transporting ideas that make the Poles more efficient, because they had never seen that before. So when you look at the data, you're going to see that the Polish investment that they received from outside of Poland was very productive. Possibly even more productive than the simple model would predict, because it's transporting ideas. So part of the convergence I talked about at the beginning of the lecture is in the data contained in this capital movement. We talk about embodied technical change. So embodied in the new equipment. The guys say, well, I've never seen one of these before. And now that I've seen it, I know how it works. So I'll never do anything else differently again. I'll always use this software. I'll use this CAD-CAM system or whatever. So, let's just try to use the ideas that I just gave you to separate those two effects. And the truth, if you look at the effects of, if we do go to Gubin and look at the investment there, we'll see that part of that is obviously they just didn't have the capital. And the other is the Poles really learned something when the Germans brought their plastic cutting machines that they'd never seen before. They'd used some other different, less productive way of doing it. Okay, so how do we think about this in the diagram? This is what I've been trying to tell you about, moving to a common point on the intensive form production function with a common marginal product of labor and capital. And this is what the embodied technical change would involve. Actually, the production function shifts in Poland. So try to keep that, and again, I tried to tell you that, in the simple Edgeworth box, we try to minimize that influence, we ignore it, but in fact, it could also be a very large effect. So you see two things happening. Moving from A to E means moving along the old production function, but actually you're not using the old production function, more using a more productive one. So, this is a great news if you're a receiver of FDI, and it doesn't necessarily mean you're a loser if you're losing the FDI because the technology doesn't go away. If the Finns have been using the Nokia technology, they'll use it afterwards, if they're using it at all, right? That's the hope, okay? So how do we measure this? This is really interesting. So we can actually look at capital mobility in practice. How long does it take for this to happen? And does it happen at all? Okay, well, the good news is it is happening in Europe big time. We saw that already a little bit at the table. But we need to look at the benchmark, because it turns out that if the capital mobility really matters, and if the costs of doing the capital mobility aren't that high, you should do it right away. You should move everything. You should move everything. We should move just factories to Poland or to Romania, to Hungary, but we don't see that. Right? So again, this is a practical limitation. The theory says, well, we know what the direction should be, we know qualitatively what's going to happen, but we don't see it happening that quickly. And it doesn't even happen quickly within Germany. So what is this about? Well, this is a great example of when countries save a lot, they should put their capital where it's most productive, but sometimes they don't. This is called the Feldstein-Horioka puzzle. And this is everywhere. This is also a topic for a bachelor thesis. Okay, this just basically means that where savings occurs does not necessarily mean that savings goes to some other place, but it turns out that savings and investment are highly correlated regionally. So if you want to think about the Ländler, the Baden-Württemberg, they do save a lot. That's not just a stereotype, it's true. There's a stereotype of sparsame Baden-Württemberger. It turns out that it's not just a stereotype. It's true, they do save a lot. And most of the investment stays in the, I mean, not most, but a lot of it stays in the Ländle. Okay, so they have a higher investment rate. So the question is, these two are correlated. If the Baden-Württemberger were just interested in the rate of return, they would move it all to Mecklenburg-Vorpommern, because the rate of return and the marginal product of capital is high there. So this doesn't seem to be, there seems to be a less than zero correlation, because if the locus of investment didn't matter, you would just invest where the rate of return is highest. So there are great examples of this. East-West Germany unification. It turns out the Feldstein-Horioka puzzle did not apply as much. So a lot of Baden-Württemberger, through their banks, through investment funds, moved ownership of capital to the east. And a lot of East German investment was made possible. I used to live in an apartment in Prenzlauer Berg, and I was told there's going to be some scaffolding, and because the two doctors from Cologne wanted to renovate the building, so they're going to renovate the entire facade. So we lived with a scaffolding for like 6 months. This is back in 90-something. Okay, I won't tell you exactly, but that's exactly the kind of capital mobility that Feldstein-Horioka we're trying to find. That means that there would be a zero correlation of savings and investment in Baden-Württemberg, because Baden-Württemberg is stocked to the teeth with capital. They have beautiful houses and hotels and everything else, so it makes sense for them to push it out. Okay, but it turns out that in many countries, it doesn't work like that. So Ireland is a small country that for a long time didn't have any capital mobility, and then suddenly capital just started flowing in like crazy. Okay? And then, of course, in general, we can look at other countries and see how that correlation holds out. So this is an old paper, really old, ancient, and I always give it as a topic for a bachelor thesis because it's interesting. It's very easy to get the data, do some correlations, think hard about it. Have things changed? And the answer is yes, they have changed. But these guys pointed out in 1980 that savings and investment across the world was highly correlated, much higher than, and positively correlated. So, you know, Japan saves a lot, Japan invests a lot in Japan. And if the theory was right, then Japanese would just put all their excess savings somewhere else quickly, because theoretically the rates of return were off. Okay, would it be off? So if you think about it, just the fundamental equation, remember this one from macro? Okay, you probably memorized it, probably forgotten it. Okay, the left-hand side is the domestic source of excess savings. Okay, so you've got savings minus investment of the private, meaning households plus corporate sector. And the second, T minus G, is the government surplus. So that's the total national savings. Okay, if you divide it by GDP, you can do it as a fraction of GDP. On the right-hand side is roughly the current account surplus. It's trade, balance of trade in goods and services plus some other stuff. Okay, it represents, the right-hand side represents how much do we export more to the rest of the world than we import. By definition, that must be how much of my savings relative to what I'm spending at home. Otherwise, it doesn't add up. Otherwise, you mismeasured something. Okay, so if you remember that one, you get a super job, because you know countries that are developing very fast often have current account deficits because they're importing capital goods to build up their economies. Sometimes they're doing it because the people aren't saving enough, they're spending on consumption goods. So the deficits can be good deficits, they can also be bad deficits. Current account deficits, right? So if you compare Argentina to Korea, over the past 30 years, you get that impression that they can be different. Okay, so basically, Feldstein-Horioka said, well, look, you know, if nations are not allowed to run perpetual deficits, then in some sense, S and I kind of must move kind of together. Just an assertion, but it makes a lot of sense. Country can't borrow money forever. Okay, but you know, these are all things you can challenge. It should be the case that the correlation is not necessarily positive, not necessarily negative. It turns out that it's generally positive. So this is our own calculations over recent years. This is over like a 50-year window. Okay, so Australia has a very high correlation. Okay, they have a lot of savings that just stayed in Australia for whatever reason. Norway, negative, because Norway discovered oil, and maybe there's almost a drop in investment, people just pushing money abroad, a lot of savings, not much investment. Okay, so then you move to the United States, it looks more like Australia, and the world is about 0.52, so it's positive. There's still a positive correlation between savings and investment rates across time. Okay, so that's kind of a hint that maybe, and there are ways you can, if you write a good thesis on this, you'll have to explore why. You can still kind of explain it because maybe the opportunities and the savings occurred at the same time within a country. But if you do it for the whole world, it's still positive. But it's changing. Okay, so this is taking it a slice year by year and looking at what happens. Okay, so this is in 1965, the correlation was very high. And then you see it dropped over time. Every slice for the next 40 years, and then you see it rise again. So it could have something to do with uncertainty in the world. Maybe this has a little bit to do with the financial crisis, because the financial crisis made a lot of investors really nervous. So I'm going to invest at home, and therefore high-saving countries have high investment rates. Okay, you can look at German unification. This is a great example of where it works. Okay, so this is investment in buildings and equipment for all of East Germany versus all of West Germany. And this is when I first came to Berlin. This was really exciting for people like me to study this. You can see that the investment rate in East Germany was huge. For structures, it was 35 to 40% of GDP at the peak. So they were building buildings all over the place. Most of the buildings you see here are a product of that period. And they're still here, right? And they're owned by people outside of East Germany who are actually not living here. Or maybe they have some shares in a fund that's in Baden-Württemberg, and they're investing here. So who knows? That's the interesting thing about capital flows, is that sometimes they're very hard to trace. But you can see that over time, things have kind of slowed down, and now East Germany, it's looking, this is a 10-year-old picture, things have gotten more convergent over time. So you don't have this feeling like there's an investment boom here. But maybe with Tesla, maybe with Magdeburg and Intel, it will change. These are really big chunks of capital. We're talking about billions, a thousandth of a trillion euros that are flowing into. So we'll see in a couple of years when Tesla is really running and when Intel and Magdeburg is running, whether this makes a difference. Okay, but you can see that basically this Edgeworth analysis seems to be on target because we're moving towards the diagonal. Right? We're moving towards some level of common GDP per capital per labor unit. Okay, and here's some detail in case you're interested. I think the conclusion was tax. The tax has a lot to do with it. So one of the big East German benefits was if we build a house in East Germany, you get lots of tax breaks, especially if you rent to somebody else. Okay, so a lot of West German dentists came to Prenzlauer Berg. Okay, but in the meantime, they got rid of that. And they didn't do much to make it attractive to build factories here. So who does that? Who makes it attractive to build in Grünheide? Have you been following this? It's really fascinating. I've been following because I live in Brandenburg. Grünheide, Tesla. Mega, I'd love to go take you there. That would be a great trip. But Elon doesn't allow us to do that. That's a real capital. If you have a chance, go to Grünheide and just look at it. It's mega. It's like that Zeppelin factory, tropical islands. Okay. Yeah, so how do you influence it? Who influences that? Yeah. Right, exactly. So the Land, Brandenburg, opened up its wallet and said, okay, yeah, you can pollute our water and do whatever you want. We need those jobs. pretty good. I don't think the water's a big issue, but some people do. It's a great job machine, right? Thousands and thousands of jobs and well-paid jobs. Okay, but they didn't do enough of that. If you go back and look at this after the lecture, you can see that investment in equipment, in the K that really, really matters, was less than the K in structures. Some of that structures matters. The big building in Brandenburg matters, but houses in Brandenburg maybe less so for productivity, because you can't use the house to generate GDP. Okay, so you see this has changed, and you see that over time the transfer rate has declined. Ireland is my last example. I really like this one because it raises a lot of interesting questions about the European unification project. Okay, so Ireland used to be called the poor man of Europe. Small country, maybe 5 million people now. But when I first started looking at it, it was like 3.5 million. So it's really grown. A lot of Irish people who live in the United States and the UK have remigrated. They've come back, right? So why? Because it's an attractive place to be. It's not the Ireland of the 1980s anymore. And they've got peace and everything else. So if you look at the data, huge, huge FDI. Okay, so this is, these are not rates. Again, you have to be very careful when you look at this. This is ownership of capital in Ireland. So it's how much of the capital stock measured in Ireland is owned by, as a stock by foreigners. That's quite a bit. Doesn't mean that the Irish are completely out of the money. It just means that there's a lot of capital in that country. And it's probably not sustainable, okay, because the Irish are getting richer. They're going to buy back some of that. They've changed their tax rules. Okay, the Irish have understood that this is causing some tension because they cut taxes for corporations, and a lot of corporations moved capital, not surprisingly, to Ireland. So a lot of United States companies have a lot of, I think Starbucks, but certainly Microsoft, a lot of intellectual capital is situated in Ireland. This weightless capital is productive, but it's not necessarily productive for Irish people. It's productive for, Bill Gates or somebody who owns that intellectual property abroad. Still, there's a lot of FDI in Ireland that's very productive. There's no question about that. Okay? So I misspoke. This is a fraction of GDP as a flow, not a stock. So that makes more sense to me. I was kind of holding my breath for a second. In that particular year, in 2015, a lot of intellectual property was pushed into Ireland. So the ownership was just established in Ireland through a shell company for many corporations. Also, there's some German companies involved as well. So this is looks like a lot. It was a lot, but a lot of that was also not weightless. A lot of it was building factories, like Dell has a big factory, has many factories in Ireland. And you can see from the data that these are substantial flows. It's also fluctuating over time. It's been rising, but it's also come down quite a bit. So these things are not forever. Someone can pull the plug. That's the risk, right? I mean, imagine, actually it's already happened with Brandenburg. Elon Musk announced he's not going to build batteries anymore in Brandenburg. Well, that's a shame. I was kind of looking forward to those batteries. I mean, if you want to have an electric car, you got to have the batteries. So that means the Tesla is going to be more expensive because they have to bring the battery over from some other place. Think about it. Okay? So fluctuations are possible. You got to be careful not to confuse or conflate like I did myself, because FDI flows are not the same thing as FDI stocks. And if you get the data, if you're writing a paper on this, check it. Are we talking about the stock of accumulated capital that's owned by foreigners, or is it the flow in this year? Because the media describe it alternately in different ways. Usually, if you look at scientific publications, they talk about the net investment position as being the sum of all the ownership. Okay? That's the completely accurate way to talk about it. I'm talking about I because I makes K bigger, and I does not have to be financed by us Thank goodness we can get the foreigners to finance it. And that means that the same identity I told you about before, if you just write it like that, if you have a negative left-hand side, that means that somebody is financing your expansion of your capital stock for decades, okay? But it doesn't mean you're going to be in the hock to the English or the Germans or the Americans for the rest of your life. Because if you grow fast, you can buy it back. And you will buy it back. You see that all the time. It gets depreciated anyway, and sometimes the foreigners say, hey, I'm done with that. You can have it. You can have everything for a price. Okay, so that's the dynamic of capital flows over time. Now, Ireland is amazingly successful. I want to make that clear. This FDI may have aggravated some people who are nationalistic, or maybe we don't want these English people owning our stuff, or the German people, or the Americans. But if you look at the data, the Irish GDP per capita story is enormous. So in 1980, see the poor man of Europe, it's about 65% of the French GDP per capita. French, not France is kind of a median country in Europe. And you see that by the mid-90s, they'd already overtaken France. And now, even despite the financial crisis, despite the pandemic, everything, they're now pushing twice GDP per capita. Now, some of that is income that goes to Americans or to Germans, but as a measure of productivity, it's indisputable. If you look at GNI doesn't look so bad. It's still pushing like 200%. So the Irish have managed to move into a more of an ownership of their own capital. And you can see the investment rates are starting to come down because this tax break has disappeared. And it will continue to have effects over the future. And I know this for a fact because I actually discussed this with the ex-Irish finance minister, and he admitted this was a problem, and he admitted that they were kind of, they were kind of encouraged to change their laws because the European Union, led by France, also to some extent by the current SPD government, we're definitely interested in seeing more tax revenues coming back to Germany and France as opposed to running away because of a tax break. Okay, so this is the GNI. So this is kind of proof. So I fibbed a bit. It's not under 200, but it's actually 170%. Still pretty good, right? Compared to France, and France is a pretty wealthy country. So you go figure. So the French criticized this. Obviously, they were not happy with this, and they called this is beggar thy neighbor. It's like what Keynes said about the countries that were depreciating their gold parity in the old days. And it's not just Ireland. The Netherlands is doing the same thing. Luxembourg, there are a lot of countries that are doing this. So the European project is to somehow make it fair, have a level playing field without having too much heavy-handed government regulation of the way countries manage their taxes. Because you want Brandenburg to offer the break. I think that's important. Right? I think it's something, but you might feel differently about that if you're a liberal in the European sense, free marketeer. Okay, finally, let's talk about how this actually happens on the ground. So this happens through mediators of capital mobility. Who mediates? Who does this? This is complicated. If you own a factory in Poland, how do you know you own it? First off, how do you get the money over there? How do you get the people over there to buy the goods from Germany or some other country to build the factory? How does that happen? Well, you usually need institutions like banks. You need investment banks. You need other types of middle people, if you like. So you need a stock market usually. The stock market is usually a signal. So when integration starts, stock markets usually rise because forward-looking investors see the opportunity on the horizon. I can buy existing capital and make it much more productive. The value of the firms that exist already is higher. Tobin's Q goes up. All the things we talked about in macro. Therefore, the aggregate GDP will rise because of higher aggregate investment. And FDI figures will tend to improve. Ireland is a great example. It took a while because Ireland joined the EU a long time ago, but they finally got their act together in the 1990s, and we see what happened. But if you look at the more recent, if you look at old history, and I'll look at recent history in a second, you see that it's always been the case that countries that join the EU have done better afterwards because FDI has increased and their openness to FDI has increased. So the best example of this is Spain and Portugal after joining the EU. So we're talking about the mid-'80s, big investment boom and a big stock market boom and a big boom in FDI led by Germany, right? So Volkswagen was they saw Seat as a competitor, and they also saw an opportunity to maybe make a better car. You go figure which one is right, because firms always want to reduce competition if they can, right? So it's always this tension, but there was a lot of money from Germany flowing into Spain and Portugal after they joined. And the stock markets anticipated that and enabled Volkswagen and other companies to raise money for these projects, right? So the market seems to coordinate this pretty well. It doesn't always work. It seems to work extremely well for the Baltic states. So remember the Baltic states where they separated from Russia, and then they existed for like 10 years without any sort of real direction. They started to implement market reforms and had a market, and then this prospect of joining the EU led to an explosion of stock market prices. You see it starting around 2003, and then you see investment rising as well. And FDI, so again, Estonia is a small country, extremely productive, extremely capital intensive now, but it took 25 years. So if you go to Estonia, which I recommend, it's a really modern place. They have really modern infrastructure, modern internet. Okay, a lot of that was paid for with money that was acquired from abroad. Okay, but now, all things given, this is a real success story because GDP per capita for Estonians, wages for Estonians have risen faster than anywhere else in the European accession area. Yeah. It's a small country.
A lot of people have left the country. 200,000 people have left.
Absolutely, exactly. And that's part of the Edgeworth box story, right? So it's not just moving down, it's also moving away. So you're right, we'll talk about that next week. It sounds horrible, but that economics works like that. The people who have the least desire to stay are the first to leave, and they profit the most, and sometimes they come back. So we've seen this with Poland. After Brexit, a lot of Poles came back to the UK and have actually they brought their capital with them too. So, okay, it doesn't always work. Greece is an example where it didn't work so well because Greece had a great growth run, but as you know, they had these two crises. The financial crises really hurt. We'll come back to that at the end of the course. The question is why? What happened to Greece? So it's a matter of interpretation. I love Greece, but I have to be honest, they have some issues there. Issues of governance, corruption, competition. It's really hard to get in there and do things differently. They've also had some bad luck, right? The worst thing that can happen to you in the pandemic is that your tourism industry gets whacked again, even though the financial crisis led to a drop in investment for 10 years, and then on top of that you get this pandemic. So it's really a string of bad events. Okay, so countries that benefit from investment often do something really productive with their investment. So I'm going to show you, this is an amazing story, very, very poorly covered by the press. It turns out that capital flows from Germany have been one way into these three countries. Now, a lot of people say, oh, that's just like imperialism, but it's also efficient. It's incredibly efficient. These countries are the biggest benefactors of European integration. Poland, Czech Republic, Hungary, because they've received really lots of real capital that's owned by Germans. If you add to that France, Italy, the UK until Brexit, this gets doubled. So huge flow, and that's to 2012. And if you extend it to the most recent period, it's still sustained. It's still high. Okay, so it's a high level of foreign ownership. Not to say this is without its risk. So I'll finish the lecture talking about the risks of capital mobility, because it's not riskless. We live in countries. The EU is built on the country principle, in diversity, unity, whatever. But it means that people want to hang on to my country, my language, my history, blah, blah. It also means my legal jurisdiction, my law, not your law. So if you invest in my country, laws of Germany apply. If you invest in Poland, laws of Poland apply. And if you sign a different law, different contract, that's your problem, but you signed it. So most people insist on their own jurisdictional law. This means that you can pull the plug. Now, with a physical capital investment, sometimes it's hard to pull that plug. It's hard to move the factory away, but other types of capital can move very quickly. Okay, so we have to distinguish between financial capital on the one hand and real capital on the other. If you start pulling out your cranes and putting them back in Germany again, that's one thing, but you can also think of another type of financial capital mobility that can be very harmful. So I'm just going to allude to that. You also have other reasons that capital mobility can be risky. So you may be investing in a real asset abroad and you're producing goods with that, but the exchange rate to which you can sell into the real world may be fluctuating. It's macro. Okay? You can also have financial instability in general. Okay, so a good example of this was Hungary received a lot of loans from Swiss banks through a conduit in Austria. And suddenly the Hungarians said, well, the Swiss franc is really strong. We can't repay this anymore. We're not going to repay it. So Orban said, we're going to renegotiate this. And that's kind of heavy-handed. It's a risk, and a lot of investors, including Austrian banks and Swiss banks, were not too happy with that. And again, you can also have, and this is why we have the European Union, to establish some standardized procedures to prevent this from happening, but it can always happen. I mentioned Poland and the press. It's kind of an indirect way of making it difficult to do business in another country. You can also have the distinction that some capital is financed using loans that are arranged by the government. So the government is in the hook. If the government issues bonds to build a highway, that's also kind of financing capital mobility publicly. Okay, also has special risks. And of course, this is what you learned in my macro course, intertemporal budget constraint. You got to pay it back. If you borrow it, you got to pay it back at some point. Okay, if it's an investment, if they own it, then they get the profits. If you borrowed money to pay for it yourself, then you're going to have to repay the debt. You're going to have to service it. Otherwise, you're in default. And if you're in this risk mode, it is possible that the bank will pull the plug on you. If the bank is lending money to you as a government or as a private company, and then suddenly something happens and say, well, sorry, I'm not going to refinance that. Go somewhere else. It's likely that everybody else will say the same thing. It's like a run. It's like the SVR, Silicon Valley Bank run, except it's a country. People just don't want to lend to you anymore. So that is a problem. Sudden stop is the idea. This happened to Greece in 2008, okay? Maybe for some reasons that may not be well explained. Some are pretty obvious. So end of the course, we'll talk about that. Okay, so in a unified capital market, after the wall came down, a lot of banks got involved. A lot of banks got involved in borrowing and lending. Germans call this Finanzintermediation, financial intermediation. Okay, so a German bank locates in Poland, opens a branch, takes German savings, transfers it to Poland, lends it to Polish real estate projects that are used to buy, say, German building materials, something like that. Okay, you can see this is right after the wall came down. right after European accession, there was quite a large activity of one particular sector in this area. And I think at the time, you see this is the rate of, I leave this in the lecture because it's so interesting. Back in 2009, people were actually very optimistic about that, right? So the rate of, this is the risk premium for investing in emerging markets in Europe, okay? And it's looking great, doesn't it? Now, you know what happened after 2008. We had a financial crisis, and then a lot of banks in the western and northern part of Europe pulled the plug. Maybe it's because the banks are involved and not the stock market, because if it's the stock market, you know, that's part of the business. If you're in a stock market, you invest, you have to be ready to take the big hit. You diversify your portfolio. Banks may not exactly have the same issue. And of course, if the banks also have a hostage, which is the financial health of the economy at home, because if the Deutsche Bank or the Crédit Lyonnais goes belly up, then the local economy suffers. Okay, so there are all sorts of political issues involved there. Let me just finish by talking about this risk of the sudden stop. We have different degrees of mobility, and I talked about this already. This is a repeat of the last slide. The financial capital is extremely mobile. You just go to the market and you sell it. And that's why it's so dangerous. And we can see how this happened if we go back and look at this one. Look at the convergence. This is when we adopted the euro. Rate of return on bonds, government bonds, all the rating agencies said equal risk. Investing in Greece, 10 years, same as Germany, 5 basis points, 50 basis points, up until 2009. Okay? And then suddenly the Greek rate rose and some other countries rose. We had something like contagion, like a bank run, except it's a country run. And this meant that basically throughout Europe, countries were pulling the plug on Southern Europe and Ireland, actually, the periphery, as they called it. Okay, and the rest is kind of history. And now we're kind of back to normal. We've got people have kind of forgotten about that, but this can come again. This can happen again, something we need to worry about. And it's the risk of financial instability. And at risk is not just the financial system, but also your banks and real economic activity. Okay, so unlike last time, I actually finished on time and with some interesting ideas. I hope you're all kind of interested in thinking about this more. Think about the bachelor thesis topics if you're interested. Please go to the section and have a great week. See you later.